Hi, good morning everyone. This is take two. I seem to have pressed a wrong button in the previous attempt at this, but I'll try and keep this a little bit more concise anyway. So we're talking about a potential decline in US equities, reason being that we've seen quite a strong rally in bond markets. That's a flight to safety by buying bonds, which is sending yields lower. Now, if investors are moving into safe havens, why are equities moving higher? There's a dislocation there. So perhaps this bond market rally eases off and yields rise and catch up with equities. Our inclination is to think maybe the other way round. So basically that equities are yet to react to what's going on in the bond market. So you can see this chart behind me. This is the German bund chart. You can see the break in the contracts here. This is the gap in the contract, but you can see since the beginning of March, pretty steady move higher here. So yields moving lower in Germany, and same thing happening in the US. We're actually at 16-month lows in US Treasuries as of today. So moving over to the Nasdaq 100 specifically. This is the weekly chart, and this is what has got us a bit interested here. Is this last weekly pattern that was confirmed? It's an inverted hammer pattern. It's a pretty bearish pattern, and you can see it happen right at the 7,500 round number, just in the middle of the range that ended up being the top towards the end of last year. Now, if we jump down to the daily chart, we can kind of see the context of this a little bit better. So we can see on the chart our big declines towards the end of the year in the Nasdaq, but obviously since the beginning of the year we've had a nice rally higher. So you can see that as we pushed up towards this first green line that I've got on my chart, the 7,100 level, that was where we had that peak from November. So we had the November crash, we had a rally in November, then we fell off again in December last year. Around that peak, you can see the strength of the rally started to peter out a bit. And then finally, when we got to that next peak, just around the 7,200 mark, 100 points higher, we had that dip. We fell below the 20-day moving average. Now that could have been the top there, but big short covering rally since. We felt the market moved higher again. It was a dip worth buying. Now we've had another dip. So certainly possible that this is a dip worth buying. This is what you want when you're in an uptrend. You want to buy on these dips. But the cause for concern is that weekly inverted hammer pattern, shooting star pattern as it's otherwise known, which is a bearish pattern. And then confirming that, we have a bearish engulfing candlestick, again at the 7,500 level. And so we've pulled back to this little low here. Could use a ray to make it look a little bit nicer. So we're contending with this low at the moment. So we made a little reversal hammer pattern. We didn't really go anywhere. We got a fake break above it, and we got a drop below, and now we're just hanging around around these lows. So if we see a break below this little short line here, then we would expect a move down towards that first resistance around 7,100, potentially the 7,000 level. But given the extent of this rally, normally you see a mirror type effect in markets. We see a strong rally higher. The corrections, when they finally come, tend to be quite sharp as well. So this is something just to be mindful of. We hit overbought levels on the RSI. We've had the 7,500 level. We've seen some reversals on the weekly and daily chart. Yes, it's an uptrend, but there's a bit of evidence here to suggest this trend's about to roll over. And we've got the fundamental backup of what's going on in the bond market. Okay, so I'm going to leave it at that. Thank you very much for watching. Good luck with trading for the rest of the week.